Interglobe Aviation slips in today's trading session, down over 2% after 5.8% equity changes hands in a block deal worth nearly 12,000 crore rupees. Sources tell CNBC-TV18 that the Gangwal family has sold stake in the company.
Rate gain dips close to 8% as the growth and the margin guidance for FY26 disappoints. They project to grow in the vicinity of around 6 to around 8% and is likely to result in rate gain's weakest growth year since listing in December 2021.
Blue Dart down 4.5% following a weak fourth quarter where profit falls nearly 30%. Margins contract 200 basis points as geopolitical and macro uncertainties weigh on the business.
Maharashtra Seamless, though, is higher in trade on the back of a steady showing in the fourth quarter. The company saw 17% revenue growth while profits jumped 11% on a year-on-year basis.
Electra Green down by almost 6% as the Maharashtra government has cancelled the company's e-bus tender worth nearly 10,000 crore rupees as it fails to supply 5150 leased electric buses within the stipulated timeline.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And as we speak, well, the markets are a little under pressure. The Nifty is down 200 points. The Nifty Bank is well down close to around 400 points. The breadth of the market is marginally favouring the number of stocks that are declining. But I think it's par for the course after the kind of rally that we've seen, Mangalam.
Absolutely. We're giving up what we saw in terms of gains yesterday. And 24,800 to 25,200 has been the broad range for the frontline index. The mid-cap index giving up a bit of gains in today's trading session as well. But in terms of absolute declines, it's not as much as the frontline indices. And that gives bulls hope that maybe at lower levels there would be some sort of support. But a lot of individual stocks are on our radar. APJ Surendra Park Hotels reported a steady set of fourth quarter numbers just in line with the hospitality industry. Its profits grew nearly 45% year-on-year, further aided by lower finance costs. As the management had told us earlier, they become debt-free. Vijay Diwan, the managing director, joins us back again to discuss their fourth quarter numbers. Thanks a lot, Mr. Diwan, for joining in. Always a pleasure speaking with you. This time around a little less so because you haven't uploaded your presentation. The conference call is tomorrow for the analysts, so I'm sure a lot of them have tuned in to listen into what data that you have to give to us today. So let's start with the basic numbers. If you could give us the internals of the fourth quarter when it comes to occupancy, RevPAR and the average room rate, how does that compare with the same time last year? If you could give us those basic numbers first.
Okay, firstly, I'm delighted to be back on your channels. And to start with, 24-25 has been a standout year for our company in terms of growth, progress, and success, largely made possible for the commitment and dedication of our teams. And we are absolutely thrilled to announce our first ever dividend of 50%. This is a milestone event in the history of our company and is a reflection of our growth momentum and our commitment to share our business with those who actually believe in us. The fourth quarter results have been truly outstanding. We have had a growth of 16% on the top line, and the EBITDA in the fourth quarter has grown by...
Right. We know the reported numbers. We're asking you about the internals, if you could give us those details.
Okay, so in terms of the key highlights of the quarter four is that we have been able to retain our occupancy leadership. We are market leaders in occupancy. We have India's leading occupancy of 92%. And both our RevPAR as well as ARRs, that is the average room rate, has actually grown by 13%. So this is in line. In fact, we have exceeded expectations in terms of our performance in both ARR as well as RevPAR. And we are very optimistic in terms of our future outlook. And we are very confident of actually delivering in terms of double-digit growth in the year ahead.
All right. Hi, Mr. Diwan. Good morning. Good to speak to you as always. Nigel on this side. Give us three basic numbers. One is, how many rooms are you looking to add in FY26? What kind of occupancy do you target for the company on the whole? And the outlook on the ARR. Three numbers for FY26.
So firstly, currently we have roughly about, we have 35 hotels totaling to about 2,500 keys. and we added about 194 keys during the course of this year. And this year has been very significant because we opened 2 Palace Hotel, the Ranbas Palace at Patiala, which is Rallian Chateau Hotel now. And we opened a 15-room Lotus Palace Hotel at Chettinad. Along with this, we also opened hotels in Prayagraj as well as in Digha. So 194 keys were added during the course of the year. Going forward, we plan to add about 250 keys. The most significant is that during the course of the year, we have signed a binding MOU for the acquisition of zillion hotels and resorts at Mumbai, at Juhu in Mumbai. And this hotel is going to be converted into a glamorous and fashionable boutique hotel of 80 rooms with a very significant rooftop bar. And we feel this deal has been concluded. This MOU has been signed. It's a binding MOU. It is being signed as an acquisition cost for acquiring 90% of the stake of Zillion Hotels and Resorts at a cost of 209 crores. And this hotel is expected to open by July of next year. And we should be able to increase our EBITDA during FY27, this opening itself by about 20 to 25 crores. To answer your other question in terms of our ARR growth and occupancy, for the last 10 years, the park has always recorded, except for the 2 COVID years, we have always recorded 90% plus occupancy, and we will continue to deliver that. In terms of ARR, as far as RevPAR growth is concerned, I'm very, very confident to deliver double-digit growth going forward, because all the factors for the hospitality industry at the moment are absolutely positive in terms of passenger growth of airlines, which is expected to grow by 10%. And likewise, in terms of demand and supply, there is a huge shortage of rooms in the country.
So what does that do to your margins? Because your ARRs grow by double digit, your occupancy stays stable at 90%. Costs are largely fixed, but you are still investing in opening new hotels, new restaurants, and new bars as well. So all things put together, what are you expecting in terms of margins? What kind of improvement?
Margin improvement is definitely expected in the range of 100 to 200 basis points as we go forward, because it's largely going to happen because of high ARR in the Palace hotels, which is going to make a significant difference to our bottom line.
So if I look at your numbers, you're saying that you will add 250, keys to the keys that you have right now. So that's about 8 to 10% addition in terms of rooms. Your occupancies are the same. And then there is double-digit ARR. So can we expect revenue growth of around 18 to 20% in this year? Is that a realistic target or more than that?
It's very, to be very precise, I think it'll be double-digit growth and it'll be in the high teens. It's very difficult to say whether it's going to be 16% or 18%, but it'll definitely be in the high teens. And this is despite the fact that there have been disruption in business because of geopolitical tension with our neighbor in the month of May. And despite that, we are still very confident of delivering double-digit growth in Q1 as well.
And how many Flurys and someplace else is that you open this year?
Flurys is really very dear to us. We have crossed the 100 mark in terms of Flurys. And we have very recently opened at Gangtok, and we are about to open in Darjeeling. And we remain committed to open about 40 to 50 outlets of Flurys every year. Flurys has seen remarkable growth in this quarter. Top line has grown by 37%. On a YTD basis, Flurys growth has been 34%. And we expect this growth momentum of Flurys to continue as we enter the city of Delhi and further consolidate our position in Mumbai from about 16 outlets to about 20 outlets by the end of the next quarter.
Thanks a lot, Mr. Dewan, for joining in. Wish you good luck for all the openings and flurries in particular as well. And I'll one of these days take Nigel out to the Mumbai flurries as well, because that's what we can afford. It's a cafe, some nice pastries and maybe some croissants as well, Nigel.
Thank you, Mangalam. It's great. And Nigel, it's always great to talk to you. Thank you so much.
All right. I was hoping Mangalam had another plan in mind, but he's talking about coffee and chocolate and all. Okay, we'll go for that. Rather go for a malt, but yeah, all right.
Can't afford any of the malls that he's held at someplace else or the Palace Hotels, Nigel. So let's move.
We are actually serving alcohol in our outlet in Colaba. So we can expect that in BKC as well.
Let's do it.
All right, then that's what it is. Thanks a lot, Mr. Dewan, for joining in. With that, we'll take a short break. On the other side, we have the management of Northern Arc Capital joining in to discuss their fourth quarter numbers. Stay with us.
Welcome back. Well, a lot of these defense-related names actually are doing pretty well in today's trading session. And one such stock is Reliance Infra. Actually, it came out with a good set of numbers. However, the stock came in for profit-taking yesterday. Today as well, it opened up in the red, but Reliance Infra should come up for you on the screen. Big up move is what we're seeing, and volumes are massive for the first 90 minutes of trade. So keep an eye out on that particular name. But let's focus on Northern Arc Capital. They reported a strong sequential as well as a year-on-year net interest income growth in the fourth quarter. However, provisions rose, credit costs as well ticked a little bit higher. To help us out with the way ahead, we're joined by Mr. Ashish Mehrotra, the Managing Director and the Chief Executive Officer at the company. Hi Ashish, good morning. Good to see you in. Thanks a lot for joining in. Well, tell us, for FY26, what plans do you have for the company? What kind of dispersals are you looking at? What kind of AUM growth are you looking at?
Hey, thank you very much. Delighted to be here. If you look at it whole of last year, you saw we witnessed about 23% growth in our gross transaction volume. Our assets under management grew by 16%, predominantly driven by big focus of growth towards lending to MSME and consumers. Our forecasted, what we're looking at as this thing stabilizes, is to grow our business by about 22 to 25% for FY26. We will taking a rather cautious but optimistic stance as the market evolves over a period of time. Obviously, there are some bit of headwinds in MFI markets where we've consciously dialed down our exposure to less than 1,100 crores. So that just speaks, that's less than 10% of our balance sheet. So we are in a good spot.
All right, so you are, scaling down some of your exposure to the MFI space. Just a couple of questions, on the outlook. While you see a 22 to 25% growth in your AUM, what is, likely to drive this in terms of sectors? And secondly, retail as a percentage or direct to customer as a percentage of your loan has increased from 19% to about 52%. How much is that likely to be next year?
I think we expect to take it upward of 60% over a period of time, and directionally our objective is to take it to upward of 70% over the next 2 to 3 years, and that will show an expansion in our NIMs. At the same time, continue to grow our credit solution business, which is pretty unique to what we do. Our ability to originate large amount of credit, place it in the market, underwrite it, process it, sell it to the institutional investors, to domestic investors who wants to participate in the high quality fixed income papers, invest from our asset management, from our AIF and PMS, essentially from a funds business, and support it from balance sheet. And that creates a unique fee franchise for us, and which is essentially a kicker on the numbers which we have. If you look at it sequentially over a period of time, that contributes anywhere between 80 to 90 basis point on our NIMs.
So if you could give us a sense of, every percentage increase in your D2C, how much does that improve your NIMs or how much does that improve your profitability by? So then, we'd understand that if this goes up from 52% to 60%, what is the corresponding improvement in the NIMs?
I think the way to look at it, you should see an expansion in NIM from about 200 basis point over a period of time as we continue to expand and build the direct-to-customer business. And that's predominantly focused towards building the secured book, addressing the needs of small businesses. We have close to 70 branches. We intend to expand that sequentially. So further build the direct-to-customer business around consumer. We work through a bunch of partnerships, both financial institutions and non-financial institutions, essentially addressing the needs and have the ability to process large quantum of credit. I think we are pretty confident as we think shaping up to see the growth in these two sectors. If you look at last year, that's the primary driver of growth. That business actually grew by about 30% year on year, while we consciously degrew our MFI exposure down to 27%.
Okay, all right. Let's talk about a little bit of the asset quality then, Ashish. Tell us about the credit cost that spiked up, and what's the outlook on asset quality for FY26?
I think the way to look at it, so asset quality, our GNPA and NNPA remained fairly well within the range point what it has been. Your credit cost has gone to about 300 basis points. That includes two one-timers. We did a management overlay of about close to 70 crores as part of provisioning. And the second, which is today also got covered in the paper, is the accounting adjustment on the default loss guarantee, which we thought it's prudent enough while the regulator gave us time to adjust it, to take it in one go. If you remove that, you see 60 basis point reduction from 300 basis point to about 240. And if you adjust both of them, you are predominantly in line with what probably 210 basis point, which is probably the best numbers if one looks at it.
And that is what is likely to continue as well, right? Can you give us guidance for NIMS, GNPA and credit costs for the next year?
I think as Sensex, we should be able to be range bound around 240 to 250 basis point. As we grow our direct to customer business, it will come with marginally higher credit costs, but at the same time, it will have a compensating significantly higher NIM. And I think that will provide much needed tailwinds for the business.
Take that point. Thank you so much for joining in, and always a pleasure speaking with you. Wish you good luck for FY26 as we speak. With that, let's get you some ideas for profit from our colleagues at Money Control Pro. Khushbu Rai Gupta joins in with the stock that she's tracking. Khushbu.
In today's idea for profit, we have Aditya Birla Capital. The stock has outperformed the market led by consistent growth and the merger of Aditya Birla Finance Limited with the parent company effective April 2025. If we look at the recent performance of the company, despite the growth recalibration in the high-risk unsecured business, the company has achieved healthy growth in the March quarter. After the merger, the company aspires to double its NBFC loan book size in the next 3 years, led by a greater focus on the high-growth MSME business and an increased focus on personal and consumer loans growth. The sweating of the existing branches and increasing contribution from digital channels will remain key growth levers for the NBFC business. The merger will also act as a performance booster on account of operational efficiencies and more cross-selling opportunities. Apart from the greater financial strength and direct access to capital, the amalgamation has also enhanced the stock valuation due to the elimination of the holding company discount. However, we feel that any future valuation re-rating will be dependent on the sustained risk-adjusted growth for the company.
All right, Khushbu, thanks a lot for that. Well, time to slip into a short break. We'll get you more on the markets and on stock-specific action on the other side.
Welcome back. Even as the frontline index is down by about 200 points on the Nifty, the broader markets are doing well, and some of these numbers that came in during the weekend are getting continuously rewarded. Translate Lighting is one of them. Was up 5% in yesterday's trading session. Good numbers came in, and this morning opened absolutely flat and currently has moved to the high point of trade with a gain of about 5%. In the last two trading sessions itself, the stock has clocked double-digit in terms of gains. We're talking about, good gainers. Credit Access is the other one which has clocked in double-digit gains in this week at the last couple of trading sessions, and most of that has come by in today's trading session itself, up around 8.5%. And then from the F&O pack as well, we have a couple of these stocks doing well. We have PI Industries, which has moved higher, Supreme Industries has moved higher, and we have Godrej Properties too, which has recovered from the lows, leaving the mid-cap index lower by just 0.1%. So that index has actually improved, with the advanced decline also moving a little more in favor of advances, 1,130 stocks now in the green. With that, we will wrap up on this edition of Chartbusters. Thank you so much for watching. From Nigel, me, the entire team, thank you for watching. You have Trading Hour that comes up next.